and gentlemen, markets are in panic mode. It's actually a mourning that's happened on Dalal Street ever since crude oil prices started to rise, and now at a 44-month high, they are creating havoc in the import-dependent Indian economy. Across the board, there is selling pressure, save for one or two pockets which are actually irrelevant. Investors are bleeding, indices are breaking support levels, and there is generally panic all around as far as portfolios are concerned, as far as monthly SIPs are concerned in quality mutual funds. What should you be doing for your mutual fund portfolio? This is a $1 million question that we will be putting to Ms. Shweta Rajani, Head of Mutual Funds at Anand Rathi Wealth. A very warm welcome to you, Shweta ji. I wish I could say this is a good morning, but there is a bloodbath on Dalal Street. What are you telling your Ultra HNI clients at this point of time who have very large investments in mutual funds?
Good morning, Sharendraji. I will definitely say this is a good morning because, while we are seeing a bloodbath, but actually if you break it down and see the numbers, Nifty had seen a peak of around 26,300 early Jan 2006, and from there, in spite of a war going on, we are just 10% down from that level. Of course, if we see, one can also say that for the last 1.5 years, we are 10% down. However, a 10% correction is something which is very normal for an equity market, and therefore anyone entering into equity should be expecting this kind of a volatility. In fact, if I look at data from 2001 till today, every year for whatever reason, the average correction from the peak of that year till the trough level of that year has been an average 15%. So if you compare to that and where we are today, a 10% fall is not such a scary number. And therefore, one should not be so worried about that. In fact, the second data I want to share here is that we had done another study where we saw that whenever there are war-like situations and markets could have fallen 30, 38%, 40% from the peak levels, and that includes something like 2008 or 2020. If somebody has stayed invested for the next 3 years, they would have experienced anywhere between 25 to 30% per annum returns as well. So what I'm trying to say is when the mean reversion takes place over a 3-year period, so which means if you are a 3 to 5 year investor and you witness something like you're witnessing right now, you would still end up, basis the historical data, decent double-digit returns from your equity portfolio. So while you are seeing this correction, my take here would be do not panic. In fact, use this as an opportunity, and if you were you were planning your equity investment, you should go ahead and do that right now.
Okay, ladies and gentlemen, I'll request the PCR to kindly fire the long-term chart of the Nifty. When the Indo-US trade deal was announced on 3rd of February, the index opened gap up and hit an all-time high almost of 26,341. From then on, the sell-off has resulted in a loss of 2,600 points. This is what Ms. Rajani is pointing out, that a 10% correction has happened, and this is the kind of volatility that you should expect. Now, the problem is that this 10% correction happened over 34 days, and that's the pain, that it has climbed on a staircase but come down on an escalator, and that is creating a lot of pain, not only in Nifty holders, large cap equity diversified funds, but small caps and mid caps have been trashed beyond belief. Shweta, the issue here is what should investors who chose in hindsight only mid cap funds and small cap funds are now facing a lot of pain. In the same duration, the mid cap and the small cap funds have fallen very, very sharply. How do you handhold their pain, and what do you advise to them?
Sure. So two things here. One, I think the basic principle of diversification works everywhere, and one should not build their portfolios basis what I would call as recency bias. So if you've seen mid-small performance being well over the last few years, don't go overweight that market cap space. It happens not just with market cap allocations, it happens with asset classes, it happens with sectoral allocations as well. So which is where when you're constructing your portfolio, however good the numbers may look for mid small. I think it's always good to maintain a balanced portfolio between large cap, mid cap, and small cap. Like even in the best case scenario, having a 50% large cap in your portfolio will help you in situations like this. If you've not done that, I think today is the opportunity for you to build your large cap portion and balance out the risk that you've taken in the portfolio. Now that you already have it, that's the second point. If you look at it from fundamental standpoint, with the earnings season now gone by, you have 9 months data. Actually, if you see the earnings for mid cap companies have been held steady. Small cap also in pockets, we've seen good amount of earnings coming in fact, better than large cap earnings coming in. Of course, we've seen a significant correction, which does happen when your sentiments are down, especially in war-like situation. Mid and small caps also get the most amount of beating. But one data point I want to show you in fact, talk to you about is if you look at it in the last few days also, the numbers are showing that small cap funds are still receiving net positive flows. In fact, just some data I was seeing for few funds, talking to certain fund houses, we were seeing small cap funds are receiving net flows. What this tells us is that the retail investor is playing very smartly and building on the small cap positions. The domestic sentiments is not necessarily bad. They are looking at fundamentals and smartly building their portfolio. And with the mean reversion playing out, fundamentals intact for mid and small cap. If it's your long-term position, then you need not be so worried. Just have a balanced portfolio would be my take here.
Okay, Ji. Now, so one broad view, would you offer that at this point of time it would be stupid to stop SIPs, whether it's in mid cap, small cap, large cap?
Definitely, you should not stop your SIPs. And the beauty of SIPs is that the rupee cost averaging that we all talk about actually works the best in these market scenarios. If you have your SIPs running, whether it is in a mid cap fund, a small cap fund, multi cap fund, any fund, don't stop. Continue. If you were planning a step up, go ahead and do that. If you were planning a new SIP, do start that. If you have funds, sitting in the bank account for any kind of a lump sum investment that had to go in equity, this should be looked at as an opportunity. However, don't look at it as a short-term play. Equity investing in your portfolio should be from a long-term perspective. If that's your horizon, then at no point of time you should stop your SIPs. One study that I had done showed that, if you have started off your SIP and let's say even in a mid and small cap fund, the first year has gone down by 15-20%. If you still continue your SIPs for the next 4 years, so you have a total 5-year period of an SIP running, even in a mid small cap fund, in spite of the first year being bad for you, you would still end up with double digit returns closer to 14-15% in that SIP. That I would say clearly fundamentals are intact. I'm repeating. So with the geopolitical issues resolving or de-escalating over the next few months, quarters, the sentimentals would turn and you would see your equities delivering.
Fair point. So 2 or 3 things are very clear, ladies and gentlemen. One, don't stop your SIP, whether it's in an mid cap, small cap, or an equity diversified fund. At this point of time, it would be sensible to not only continue your SIPs, but possibly make a fresh one. Of course, we don't know where the markets will take support or where will they reverse from, but we've always seen that buying the pain over the longer term creates a lot of positive wealth in your long-term portfolio. So Shweta, at this point of time, for those who wish to maybe deploy a small amount of new money into Dalal Street, what would your sensible advice be? What should they be choosing?
The first thing I would say is go in for diversified mutual funds. At this point of time, people may want to, go towards specific sector, but that should be avoided. Let it be with professional fund managers who would very actively take your sector decisions. So that's the first thing. Don't go in for specific sector funds. Go in for well diversified equity mutual funds. Within this, you can have a portfolio which, like I was mentioning, can have up to a 60% of large cap. And the rest of it, if you're building long-term portfolio, can be a mid-small cap oriented portfolio. So, 55 to 60 large, the rest of it being mid-small, can be an equal split, would be the second point over here. The third point, I would say you can go in for categories which are like flexi cap, large and mid cap, multi cap, and maybe just have one mid small cap fund in your portfolio. So these are categories where fund manager tends to have a little more flexibility in terms of the active decisions that they can take according to the SEBI rules laid out for them, and have a portfolio which would have closer to minimum 6 to 8 schemes, because you said it's a smaller amount. As the amount goes up, you can also increase the number of funds. But this is how I would say, for someone looking at building their portfolio today, keep these three things in your mind.
Okay, let's look at the let's look at the fund choices that Anand Rathi Wealth is advising its long-term clients, customers, howsoever well you may want to categorize it. So Shweta, your choice in a good quality multi-cap fund, I would suggest you mention two names, because sometimes it so happens that one of the funds is already in the long-term portfolio, so you get a choice.
Absolutely. So I would say here, if you're looking at two funds, you can go in for a Kotak multi-cap, or you can go in for a Canara Robeco multi-cap. Canara Robeco will have a little more growth biased in the portfolio. Kotak multi-cap, to that extent, is a mix of a growth and a values style. So it's a blend.
Okay, so these are the two choices that have come in from the multi-cap space. What would be your top pick in the flexi cap space? Maybe if you can just name 3 funds, people would be better placed to choose either one of these 3.
Yeah. So my first choice here would be that you can go in for an HDFC flexi cap fund. Given the track record, the size, the way they have scaled through different market cycles, consistently performed. So HDFC flexi cap, you can also go in for maybe a Kotak flexi cap in your portfolio, or you can go in for a Canada flexi cap in the portfolio.
Okay, so Canara Robeco seems to be an AMC that you really like. We've had an overlap with multi-cap and now with flexi-cap as well. Fair enough. So these are, ladies and gentlemen, broader measures. The name itself suggests that the fund manager has flexibility to buy at this point of time whatever he finds working very well in the mid-cap, small-cap, large-cap name. Therefore, the flexibility of that comes under flexi cap, and of course in the multi-cap space where 25% has to be deployed in mid, large and small caps, also allows the fund manager an equal freedom to put in that money. Now comes the difficult part, Shweta, the choice in mid-cap space, something that's really been in pain, but amongst the best performers in this space which has really contracted, what would be your 3 top picks?
So I would say over here, if you have to go in for a few funds, Kotak Emerging or the Kotak Mid Cap Fund, then there is also an HDFC Mid Cap Fund that you can go in for. The third one, if I have to pick, I would say maybe an Invesco Mid Cap Fund.
Okay, so Invesco Midcap, ladies and gentlemen, we've reviewed many a time, and this is one of those top outperforming funds. If I'm not wrong, the HDFC Midcap Fund has an asset under management of more than 70-80,000 crore rupees, one of the largest funds across market spectrum as far as the fund is concerned, and of course fabulous returns over the last 2 decades in HDFC Midcap. So that pretty much defines how the markets are at this point of time in equities. Shweta, would you want a commodities fund in the thematic space to be a part of this fresh portfolio, or we stay away?
So I would look at it this way. If you're building an equity portfolio, then there would not be a space for any commodity fund. However, let's say if there is an investor who has whatever 60, 70, 80% of the portfolio towards equity and is holding some debt in their portfolio. So maybe a gold as commodity can be a portion of that debt component. So just to put certain numbers, if somebody has a 20% debt in the portfolio, maybe they would want to split it as 10% debt, 10% gold. But still at this point of time, if you see, even gold, which had touched a $5,600 per ounce of peak, is down to around 5,200 odd levels. So even gold, which is supposedly to be a hedge against such in global situations, is right now seeing almost a 10% fall from the peak level. So that's one thing that one should always keep in mind, that gold is not completely off volatility. It also goes through its cycles. So coming again, not a portion of your equity portfolio, not a replacement for equity, definitely. But if you have debt, it may be a good thing to have it split between a debt and a gold.
Okay, fair point. So that's the view that is coming in on the commodity space. Shweta, these are also trying times. Would you be focusing on maybe an aggressive hybrid fund where you have the benefit of debt, the possibility of an interest rate rise from current levels doesn't seem to be out of the window, but again, your choice. In the overall structure, would you want an aggressive hybrid fund as well?
So I'll break it up into two parts. What I have seen is most investors take their asset allocation decision on their own, and they decide what kind of an equity they want in the portfolio and what debt. So if you are in that bucket of an investor who's already decided, maybe I want 50% equity, 70% equity, then a hybrid fund is not for you. Separately managing equity through pure equity funds, having debt through maybe debt funds, arbitrage funds, small saving schemes, may be the right thing for you to do. However, if you're an investor who's just starting off on maybe not too sure of what's the right asset mix, then hybrid and an aggressive hybrid works for you, where you're leaving it to the fund manager to decide what asset mix should be invested in given a certain market situation, wherein also you'll have a minimum of 65, maybe 65 in equity, and it'll keep shifting. So you're okay to have a little more equity in your portfolio, but you're not too sure what is the right asset allocation for you. Then hybrid and an aggressive hybrid category is meant for you. So if you fall in that bucket, then maybe you can go in for an ICICI or an HDFC hybrid fund, aggressive hybrid fund.
Fair point. Final comments, Shweta. What exactly are your clients telling you? For those who came in the markets in the last 14-15 months, they haven't made money, but because they've been handled by you, they continue with the SIPs. What are you telling them as far as the market sentiment is concerned?
So, for our clients, we've always been maintaining this stance that if you are investing in equities, you should hold it with a long-term perspective. Equity, the nature of the asset class is such that it can go through periods of 1-2 years of time correction, which means not moving anywhere, or it can go through price correction. It is also an asset class where you could see 35-40% corrections coming in crisis kind of a situation, which we've seen in 2008, few wars, COVID. But the rebound also is sharper whenever that takes place. So which is where our clients, look at corrections as an opportunity. And, sometime back I was mentioning, if from 2001 you look at it, every calendar year, for whatever reason, from peak to trough, markets would have fallen by an average 15%. And it takes around a year and a half to recover from those levels. But then for a 5-year rolling kind of a period, you would have seen closer to double digit returns or double digit returns coming in most time periods. So this is where one should not panic when you see these situations, and look at it as an investment opportunity to build your equity portion of the portfolio. So yes, they are continuing with their investments, they are continuing with our SIPs,
Okay.
and not panicking.
Okay. So continue with your SIP. Don't panic. Take this correction as an opportunity to buy quality and hold for the long term despite price and time corrections. My final question is on CNX IT index and therefore IT funds, Shweta. What is the house view on the IT sector and IT sector funds? Do you see at this point of time an opportunity to buy into ITB's ETF?
So, the straight up answer there would be we would be a little cautious and right now stay away from it because there are too many uncertainties. One, the sector itself, I would say, is going through a lot of changes. Yes, the Indian IT companies, especially, a lot of them, I would say, would be and would play a very important role in this transition from the traditional way to the AI approach. And, the entire migration, the data storage place. IT companies in India can play a very important role, but right now it's not just the technology, but it's a mix of technology being used in geopolitics and a lot of those issues impacting the sector. So maybe right now stay away, let certain aspects clear off, some time passing by, and then it can be considered. But right now, it would be a no to IT specific schemes for us.
Well, we'll pause it here, Shweta, and thank you for such wonderful advice on how to navigate this extreme volatility in the markets. We'll, of course, review these 7 funds that you've told us on our own. But thanks once again for being such a sport and offering such a fantastic practical advice.
Thank you so much.
That, ladies and gentlemen, was Shweta Rajani, the head of investments and mutual fund research at Anand Rathi Wealth. Let me just give you a gist of what she has said. Corrections, especially more than 10 and about 15% in the markets, are an opportunity to remain invested or maybe buy a quality fund asset. Do not stop your SIPs. 3, look at a flexi cap fund or a multi-cap fund to make a fresh investment at this point of time, simply because the fund manager has the flexibility to buy a quality mid-cap, large-cap and small-cap stock in his long-term portfolio, and buying the pain literally has given supernormal returns over the medium to long term. Her stock picks, actually fund picks in the flexi cap space, have been HDFC Flexi Cap Fund, Kotak Flexi Cap Fund, and Canara Robeco Flexi Cap Fund. Either one of those should be in your portfolio. In the multi-cap space, she prefers Kotak Multi-Cap and Canara Robeco Multi-Cap, and in the mid-cap space, Kotak Mid-Cap, HDFC Mid-Cap or Invesco Mid-Cap. Again, please consult your individual financial advisor and mutual fund advisor before you buy or augment the following funds that we've discussed. Thank you for watching. This too shall pass. We've seen many a bull and many a bear market. The pain is there, yes, but for those who withstand the pain and those who have the ability to navigate in terms of liquidity and fresh purchases, ladies and gentlemen, hold your faith and be positive. Thank you for watching. Stay glued to Business Today Television.
Markets move today to what's setting this